Well, we saw some weakness filter through to the local unit and on Friday, and that seeming to be continuing at this stage where risk aversion is very much back on the table.
Yes, indeed. We saw very disappointing US employment data come out on Friday, which really stopped Rand bulls in the track at the level of about 665, which incidentally is the same level that Rand bulls ran out of momentum in June. So we're really seeing a trading range of about 665 to 705, which is part of a broader 6-month trading range of about 654 to 740. So we do believe that Rand participants should play these ranges accordingly, which at the current levels really mean that, or rather imply that importers should cover forward, while exporters should wait a while before repatriating their dollar earnings.
We've got some consensus emerging from the markets that the global economy is going to bounce back from this soft patch. Your view, given the economic data that's filtered through not only from the US in the forms of jobs data on Friday, but also with regards to on the back of the Chinese data we saw filtered through this morning as well?
Indeed, we do expect it to bounce back, but the current information is really pointing to the global recovery that's remaining quite fragile at the moment. And given the fact that ECB ministers are pushing forward for further assistance for debt-laden Italy, it's really it has caused risk aversion to return. And in turn, we're seeing the dollar, the gold price, and the Swiss franc, for instance, benefiting, and risky assets such as emerging market currencies really selling off. But we do believe that in the longer term, we do see the global economy coming on the mend.
What specifically would you be looking out for when it comes to that emergency meeting being held over in the Eurozone, where we've got Italy now the point in focus?
Indeed, that is a bit of a concern that they need to find assistance, debt assistance for Italy, and that could potentially cause the Eurozone economic recovery to possibly derail. And implications for that is really that the euro will come under pressure, and the Rand has been tracking international movements over the past couple of weeks, and we expect that to continue over the course of this week with a very little local data coming out as well.
But it's really a case of which economy comes to the fore with less worse data, it seems, because this week we've got economic data filtering through from the US in the forms of a retail, CPI, industrial data as well. So what are you pricing in that regard?
The data is likely to be coming softer than what we have seen over the past couple of months, but I think the main concern is Bernanke's speech earlier before the data is expected to come out of he is expected to deliver his semi-annual testimony, and indications there is that he is expected to provide further indication of where the US economy is going, and we really do expect that for him to reflect further softness in the economy with a very mild recovery going forward.
With the growth scenario globally in focus, we've got our manufacturing data being anticipated tomorrow as well. Forecast in that regard, Shireen?
We're expecting an increase of about 2.3% from a slowdown to 0.4% year-on-year the previous month, but it's still more or less in line with our GDP forecast of about 3.8% for this year.